For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Palantir Technologies has once again captured the spotlight as its stock sees a boost in value during today's trading session. This positive movement came on the heels of a revised price target from Bank of America, one of Wall Street's most influential financial institutions. The bank raised its forecast for the company's stock to a new all-time high, reflecting growing optimism about Palantir's future prospects. Leading this bullish revision is Mariana Perez Mora, a highly regarded 5-star analyst. She increased her price target from $125 to $150 per share, citing the company's unique approach to artificial intelligence as a key driver of its potential long-term success. According to Perez Mora, rather than focusing on mass-market software, Palantir specializes in deploying targeted tools that produce measurable outcomes. This allows the company to differentiate itself in a rapidly growing but increasingly crowded artificial intelligence landscape. She also pointed out that Palantir's most recent earnings results demonstrated notable improvement in the company's ability to bring new products to market quickly, while simultaneously converting a higher percentage of its users into paying customers. She also referenced a recently announced executive order titled Modernizing Defense Acquisitions and Spurring Innovation, highlighting it as a potential catalyst for the company's government-related business. This executive action is designed to streamline the way the United States Department of Defense allocates contracts, a move that could significantly benefit Palantir by simplifying the process through which it secures lucrative federal deals. However, it is important to note that this optimistic outlook is not universally shared among analysts. While Bank of America remains bullish, several other major financial institutions have adopted a more cautious stance. Notably, analysts at RBC Capital have issued much lower price targets of $40 and $60 per share, respectively. These bearish forecasts are rooted in concerns about Palantir's elevated valuation, which some believe makes the stock vulnerable to substantial corrections. Both firms argue that Palantir's current market price may not be sustainable over the long term, especially if the company fails to maintain its recent growth momentum. Overall, the consensus among Wall Street analysts is more balanced. Based on the latest data, Palantir holds a hold rating derived from a mix of 3 buy ratings, 11 hold ratings, and 4 sell ratings over the past 90 days. In terms of price expectations, the average target stands at approximately $98.56 per share. Yet despite this mixed sentiment, there are several indicators that Palantir's growth narrative remains compelling. Its reputation was built largely on its close working relationship with the Department of Defense and other public sector entities. But the tides have started to shift. A surge in demand for artificial intelligence solutions has opened up vast new opportunities for the company, particularly in the private sector. This shift has helped reframe Palantir's image from a specialized contractor to a powerful software innovator poised for long-term commercial success. Palantir's performance in the public markets further underscores this transformation. Since going public in the year 2020, the company's shares have delivered a staggering return of roughly 1,090%. What's even more notable is that the entirety of these gains occurred after April of 2023. That month marked the launch of the company's latest software offering, the artificial intelligence platform often referred to as AIP. This platform has played a pivotal role in reshaping Palantir's business trajectory and catalyzing its meteoric rise. Despite such significant gains, some analysts believe the stock has not yet reached its ceiling. Dan Ives, a prominent technology analyst at Wedbush Securities, has expressed a particularly optimistic view. He believes that Palantir could still surge another 285% over the next 2 to 3 years. Should this forecast prove accurate, it would push the company's valuation into the coveted trillion-dollar range, an elite club currently occupied by only a handful of global tech giants. However, before embracing such bold predictions, it's essential to take a closer look at the company's underlying fundamentals, operational performance, and valuation trends. Throughout its 2-decade history, Palantir has leaned heavily on government contracts to drive revenue. While the defense sector offers immense financial opportunity, it also comes with certain challenges. Deals in the public sector can be unpredictable, delayed, or subject to political and regulatory shifts. This creates a level of revenue inconsistency that investors typically dislike, particularly those seeking stable, high-growth companies. For Palantir to establish itself as a truly resilient enterprise, it needed to prove that its software solutions could also win traction in the commercial world. Over the past 4 years, Palantir has made remarkable progress in transitioning its customer base toward the private sector. In 2021, the company served a total of only 237 clients. Fast forward to the end of the first quarter of 2025, and that number had ballooned to 769 clients. Moreover, Palantir's revenue and profitability metrics continue to move in the right direction. Rising sales figures and expanding profit margins suggest that the company is not just acquiring new clients, but is also increasing the value of each customer relationship. These trends lend credibility to the bullish narrative that Palantir is well positioned to become a dominant force in the artificial intelligence-driven software market. Following the release of its Q1 earnings on May 5th, Palantir stock experienced a sharp decline. Importantly, this drop was not triggered by poor performance. In fact, the company exceeded earnings expectations. Rather, the sell-off was driven by valuation concerns. As of May 8th, the average analyst price target stood at approximately $94, implying a downside risk of about 21%. Since the launch of AIP in April of 2023, Palantir's price-to-sales ratio has increased dramatically. At the time of the platform's debut, the company was trading at a multiple of roughly 8 times sales. In the span of just 2 years, that multiple has expanded more than 11-fold. Today, Palantir is among the most richly valued software stocks on the market. For historical context, consider the dot-com era of the late 1990s. During that period, technology leaders such as Microsoft, Amazon, and Cisco traded at price-to-sales ratios between 30 and 40 before the tech bubble eventually burst, leading to massive declines in stock prices. Palantir's current price-to-sales ratio is approximately 2 to 3 times higher than what those giants experienced at their peak. This comparison raises important questions about sustainability. Historically, valuation multiples tend to compress over time as companies mature and generate consistent profits. Investors gradually shift their focus away from sales-based metrics toward earnings and cash flow as the primary measures of value. In today's financial landscape, leading technology firms like Amazon, Cisco, and Microsoft are rarely evaluated based on price-to-sales ratios. Instead, analysts and investors alike prioritize metrics such as price-to-earnings and price-to-free cash flow. Even though these companies now trade at far lower price-to-sales multiples than they did during the dot-com boom, they have nonetheless created extraordinary value for shareholders. In fact, Amazon and Microsoft have grown into 2 of the most valuable corporations on Earth as measured by market capitalization. Given this historical context, it is reasonable to expect that Palantir's valuation will experience some degree of normalization in the years ahead. However, that does not imply the company lacks potential. On the contrary, Palantir could still evolve into a trillion-dollar enterprise. It may just take longer than the 2 to 3 years suggested by the most bullish forecasts. For long-term investors, the key is to adopt a disciplined strategy, accumulate shares gradually, take advantage of market dips, and maintain a long-term horizon. Artificial intelligence is not a passing trend, it is a fundamental shift in how businesses operate, compete, and innovate. Palantir stands at the center of this transformation, offering solutions that are not only cutting-edge but also deeply integrated into the decision-making frameworks of its clients. As more organizations seek to harness the power of artificial intelligence, Palantir's platforms are likely to see broader adoption, stronger network effects, and increasing revenue per user. While near-term volatility may persist, and while valuation corrections may be inevitable, the long-term thesis for Palantir remains strong. Investors who can look beyond the noise and focus on the company's technological leadership, expanding market share, and ability to deliver results are likely to be rewarded in the future. Bank of America's top-rated analyst, Mariana Perez Mora, recently raised Palantir's price target to a Wall Street high of $150, citing its leadership in building custom AI tools that deliver measurable results across industries, along with its strong earnings momentum and increasing commercial adoption. Despite this bullish outlook, analysts at RBC and Jefferies remain skeptical due to Palantir's high valuation, issuing much lower targets of $40 and $60. While the stock has surged over 1,090% since its 2020 IPO, analysts warn of possible pullbacks due to its stretched price-to-sales ratio, now more than 11 times higher than 2 years ago. Still, long-term investors may benefit from buying in gradually and holding through volatility as Palantir expands its influence in both government and private sectors. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.